usual, preparing for this show, the Closing Bell show in recent months, if not years, has been exciting because the market often pivots in the last 30 to 60 minutes, and that's kind of a known challenge or a known issue, right? The end of the day is when you have a lot of institutions participating. That's when you have a lot of ETFs that rebalance or need to do anything. Will often come in at the end of the day, and so there's a lot. It tends to be a lot of movement in the last 30 to 60 minutes. Compare that to the first 30 minutes, which tends to be a lot more retail investors, and that's kind of the general shape of the day on average. So today, rallying, really accelerating into the close, in what you could call a blow-off rally, really for no particular reason that I could see in the afternoon, is pretty impressive. And much of the day, I'm sort of sketching out a plan for the show earlier today, and I'm looking at utilities number one. I was looking at real estate number two, and I'm thinking, wow, these are two really defensive, relatively boring, high dividend paying sectors, and they're leading on a day where the market continues to chip higher. How does that make sense? Really, you've seen an acceleration in the last hour. Technology, we're looking at the NASDAQ composite here, but you can see how it really just turned left and just accelerated to the upside, finishing up about 1%, which on the surface doesn't seem that dramatically positive. But this is after being sort of down earlier in the day, around 11:30, hit the lows of the day. So a nice turnaround and a nice bit of a follow through to the upside, and that sort of encapsulates a lot of what we've seen, not necessarily with technology, but we've seen that, even though there are plenty of reasons why, that I could give you for the market to not go higher, stocks continue to go higher. And in general, it's not about what stocks should do. It's not about what they may do. It's about what they are doing. And that's really what trend following, what momentum investing is about, is focusing on the trends. And you're seeing by breadth measures, by the bullish percent index, which we'll talk about a little later in today's show, all going to new highs. That tells you that the market overall is healthy, even with some charts that don't look as good as others. There are plenty of good opportunities out there. Notable sort of outliers today. The small cap index actually finished right, essentially flat for the day, but a little below. There's one of the few things in the red at the end of the day that's kind of worth keeping an eye on. It was down a lot more earlier as stocks in general jumped at the end of the day. That kind of popped up pretty well too. But small caps lagging is not a read that we've had normally. Now, small caps again tends to be over a lot of financials, a lot of regional banks in the small cap index, and so when financials are down, that's gonna struggle a little bit overall. So it's a little different field than we've had recently. Let's finish off looking at some other asset classes. We'll look at some of the charts. 10-year yields back down around just about around 161 or so. The TLT up about 0.6% today. That's on price proxy. Precious metals are actually up today. So gold and silver really continue to chip away, going up. And the chart of gold is an interesting one. We're gonna look at that in a second. But starting to improve, still coming off of really beaten down levels. So I think it could be earlier on in that sort of rally, but nice to see it bounce higher. Cryptocurrencies gave back a lot. Bitcoin over the weekend hit a new all-time high, just above 61,500, which is a pretty impressive run, of course, by any definition. A lot of that rolled over here, and you saw a move down, some news out of India that they were going to be doing some, sort of a regulatory focus on cryptocurrencies. So that's hampering things a bit, but still, pretty high above where it has been in history. We're still very much near to the all-time highs there. Looking at a chart of the S&P 500, just refreshing for the close here. So a new all-time high, a new closing high for the S&P, as a mentor of mine, Paul Montgomery, who wrote a newsletter called Universal Economics for probably 50, if not 60 years. It came out every week. It was a fantastic read, and it was sad to see him pass on a couple years ago. But one of Paul Montgomery and others have said, the most bullish thing stocks can do is go up, or the most bullish thing market can do is go up. We focus all these things on reads and different indicators and breadth and sentiment, all of that. And his point is, the most bullish read you can get is the price of the S&P, or the price of a stock going higher. And that's what we've seen with the S&P 500, making a new closing high, making a new all-time high. You should not be that bearish when that sort of pattern is happening. That's what I'm finding myself needing to remind myself of right about now, because I am sort of, I tend to think more about the risk side of it and think about potential downside and look for lines in the sand going down. I don't see that right now. I see the market going higher. We'd have to come back quite a bit for us to break down to the point where I would start to get nervous relative to where we're at. And I think from a stock picking perspective, there are plenty of charts that are continuing to go higher. Let's finish off our read of the big picture, looking at some macro charts. We talked about bond prices. This is the TLT. So bond prices up a little bit, yields lower, but again, that is a brief jump. Friday was a huge move down on the TLT. You see a bit of a bounce today, coming up a couple points, but overall, again, the trend in bond prices has been significantly lower. What's interesting about that, though, is if you look at the TLT, we're right down within a rounding error of where we were in the fourth quarter of 2019. That was sort of the floor before it accelerated into early March, came back into the equity low in March, but overall was in a pretty good uptrend for the next 6 months. And we're right back down to those levels for the first time since the end of 2019, beginning of 2020. So we're near the point where you could argue for at the very least, a mean reversion move back to the upside. Now you compare that to what you see with the chart of gold, and I'm seeing a very similar sort of theme. The GLD came right back down to the May, June, July lows from 2020. That's also a 61.8% retracement of the March 2020 to August 2020 rally. So we're right at that really reasonable point to expect at the very least, a short-term bottom. You're also oversold for the first time since November. So interesting to see gold bounce off of there. I think there's more upside to be had for gold. I do know that if we do start closing below 157, that really opens the way to much further lows around 136 or so, which would obviously be another leg lower. We'll try to look at gold stocks a little later when we get to our shifting stock segment. That is our market recap, looking top down at what's happening. And again, today, I think the story is really a risk on move that accelerated into the close. And as always, trends that persist, that continue, that's the path of least resistance until proven otherwise. Our next segment is called sector setup. So step 2, we've talked about the big picture. Now let's look at the 11 S&P sectors, talk about how they're rotating around the benchmark. For this, we always start with the RRG, the relative rotation graph. Julius de Kempener, one of our fellow contributors, designed this years ago. I followed his work for many years, and I still think it's one of the best ways to visualize asset rotation of any sort, asset allocation, especially sector rotation, where you tend to have this cyclical nature to how things come in and out of favor. So check out his show, Sector Spotlight, if you've missed it. He does a really good job of explaining this methodology in more detail than we can get into on this show. Now, the weekly RRG does not change that often. It's obviously based on weekly data. And so what you can see is there are 3 sectors in the leading quadrant. What that tells you, these are the best trends on a relative basis. The S&P is there at the crosshairs. So further up and to the right is a stronger trend with improving momentum. Energy is number 1. Again, even giving a bit of a give back today, that shouldn't register on a chart like this. This is more about the longer term rotation. It is telling you energy, financials are the places to be, followed closely by communication services. One of the really interesting patterns on this RRG over the last month or so has been, we had a cluster right there of communication services, of consumer discretionary, and technology, all 3 of those, which all could be considered offense, obviously, by most definitions, right? These are the juicy names that have led really into the fourth quarter of last year. From there, they've all sort of taken a break. Now we've seen very much a divergence, with communication services heading northeast, the other 2 heading southwest. Consumer discretionary now in the lagging quadrant for the first time in quite a while, and heading in the direction of deterioration. Now, a lot of these are cap weighted indexes, so a lot of this is based off of the weakness in Amazon, but overall, as a sector allocation exercise, it's telling you to lean away from things like that aren't working, things like healthcare that aren't working. What is working, it's stuff heading northeast, and ideally in the leading quadrant. So the 3 strongest: energy, financials, communications, services. The next 2 to watch would be real estate, which is the only one in the improving quadrant and heading in the right direction. The other one would be industrials, which has taken a bit of a sort of circular pattern to the right of the y-axis, which actually tends to be a pretty constructive long-term pattern. So something to keep an eye on there. Looking a little shorter term, looking at the daily rotations, this is going to get a little more granular into what we've seen over the last week. And here you can see that most of these are heading straight up and down. And what that tells you is the long-term relative picture isn't changing a ton, just the momentum is changing. What I mean is, further to the right means it's outperforming. So the strongest sectors have still been energy and financials, then industrials and materials. But the fact that they're all heading straight down, if not a little bit to the left, tells you that the momentum is coming out of that trade and heading elsewhere. So again, you've seen some rotation just in the short term into consumer discretionary, into utilities, into consumer staples, even into real estate, and it's away from financials and energy. And a day like today sort of shows why this rotation makes a little bit of sense. So again, my goal is to use the long-term rotation, which is still saying energy and financials are in good shape, versus the short term, which tells you there's a bit of a mean reversion happening, which is about right. That's kind of what this has felt like with a couple days last week with energy giving back some of those recent gains. Now let's look at the 11 sectors using the candle glance function. So this is a really good way to visualize a group of things. I always think about in my former life at a large buy-side institution. We printed out a lot of charts, probably thousands of charts a day. We had a lot of paper floating around with charts, but we would often throw them all on a table and look for patterns and look for what caught our eye, and we moved that to a separate pile, which was the thumbs up pile. And this is sort of what you're able to do electronically with the candle glance function. Throw these all in a pile, see what catches your eye. Now I'm immediately drawn to sectors that are continuing up and to the right and don't feel like they're taking much of a pause. Now, what sectors look like that to you? What looks like it to me is communication services here in the upper left, financials there, middle to the right in the middle, industrials and materials, both recently making new all-time highs, and real estate. And this is kind of a surprise. A lot of people, again, don't think of REITs as a thing. Real estate was part of the financial sector for forever and split off. I should look up when that actually was. I would guess that was probably like 2015, 16-ish, I would guess. Maybe a little earlier than that, 14. Somewhere in there, real estate became its own sector. And to be honest with you, they're always a very different look than banks and insurance companies, sort of a different beast altogether. But the XLRE is one to look at. IYR is the other one you can pay attention to. This is making a new swing high again today. It's nearing an overbought condition for the first time since June of last year. And the relative strength has certainly stopped going down. It has absolutely been sideways, potentially starting to make a 3-month relative high. If it gets just a click higher than where it is right now, that's quite a potential rotation there. And this is a sector that tends to pay, these are stocks that tend to pay higher dividends, tends to be a little more defensive, and it might be an interesting place to look opportunistically. When we get to our shifting stock segment, I'll show you a couple REITs that screen pretty well using the scooter rankings, the stock charts, technical ranking based on trends. There's some decent trends in the sector you may want to pay attention to. Looking back up here again, financials and energy gave a little bit back, but that's this one bar relative to this trend. So you can see that the trend in financials has certainly been impressive, continues to make higher highs, higher lows. The risk to this trade is that interest rates have topped, that interest rates come down, that 160, 165 is the peak for quite a while. That would kill this financials trade, at least for the short term. I could see a short-term pause. I don't think rates are done going up, but that's just my sort of big picture perspective. The trend is going to tell you everything you need to know about whether financials are a good place to be. So that ETF continue to make higher highs and higher lows. So making a higher low on a pullback would be absolutely key to watch. Industrials just keep forgetting to go down. And we've talked about the benefits of an infrastructure play, the opportunities there. And I think the industrial sector, when you look at stocks like Deere and others, pretty constructive. Long-term trends have been positive, and this has just been a consistent sector. So it's funny, while we think so much about technology that has pulled back, and you think about whether it has enough to enough gas in the tank to push to new highs, you have other sectors that are making new highs just fine, aren't worried about the market pulling back. I would certainly be looking there and seeing if there are opportunities there for the long term. We need to take a quick